Beijing just poured over 300 billion yuan, that's nearly $42 billion, into its property market in a single week. But here's the thing. This isn't the old China. The moves they're making right now, like demanding state-owned enterprises buy up unsold housing inventory, are completely changing the game for global investors in 2026. If you're like most people, you've heard the headlines about Evergrande and thought it was just one company's problem. But that was just the symptom. The real issue is systemic, affecting trillions in debt, and it means the historical playbooks for investing in Chinese real estate, or even companies that rely on it, are officially obsolete. We're going to break down exactly what Beijing just did, how it's different from past interventions, and why the fallout won't be contained to just China. And stick with me, because the last part of this is the piece almost everyone gets wrong, and it's the part that decides whether you win or lose here. Did you know that Chinese property developers racked up trillions of dollars in debt by 2021, setting the stage for one of the biggest economic challenges this decade? It's not just about Evergrande, that was merely the headline. The real issue is far deeper, with widespread defaults on billions of dollars in debt and sales plummeting across the board. In response, Beijing has drastically shifted its stance, essentially abandoning the strict three red lines policy that pushed many developers to the brink. This isn't just an internal Chinese problem, it ripples across the globe, impacting everyone from commodity traders to investors in emerging markets. We're talking about a market that saw property prices in its top 70 cities surge between 2010 and 2020. Now, with the government committed to setting a bottom for the market and easing debt refinancing, the rules of the game have fundamentally changed for 2026 and beyond. This means understanding how Beijing's latest moves will reshape global investment landscapes is more crucial than ever. So, let's unpack the specifics of these new policies and what they truly signify for the future. Did you know that by 2020, home prices in China reached over 17 times average salaries, a significantly higher multiple than even hyper-expensive global cities like London or New York? For decades, from the landmark 1998 housing reforms through the peak in 2020, China's property market experienced an unprecedented, government-engineered boom. This wasn't merely organic growth, it was a deliberate strategy. The 1998 reforms privatized housing, transforming a socialist system into a market-driven one, which triggered a massive wave of urbanization. Nearly 500 million Chinese citizens, like millions from rural Sichuan moving to megacities like Shenzhen, transitioned to urban centers, creating insatiable housing demand. Combine that with rapidly rising household incomes, aggressive promotion of property as a primary investment vehicle, and abundant, often cheap, state bank credit from institutions like China Construction Bank, and you have a recipe for astronomical growth. Property became the central pillar of China's economy, contributing upwards of 25% to its GDP annually and fueling local government finances through land sales. But then came 2021, and annus horribilis for the sector. We saw the largest developers, not just Evergrande, though their $300 billion debt and dramatic default were certainly the loud headline, but also behemoths like Kaisa Group and Country Garden, accrue trillions of dollars in debt. This ultimately led to defaults on billions of dollars in offshore bonds, rattling global markets, and sales plummeting by over 40% across major cities. The real issue is far deeper than just one company. It stems from long-standing structural problems, aggressively exposed by the 2023 Red Lines rule. This policy for property developer financing stringently limited how much debt these companies could take on, effectively yanking the liquidity rug from beneath overleveraged firms. The lesson here is that unchecked growth, even when government-fueled and seemingly infallible, can reach a breaking point. So, what happens when you have a massive boom, a massive bust, and then an estimated 80 million vacant homes sitting empty across the country, a stark testament to oversupply? Can you imagine 80 million homes sitting empty, just waiting? As of January 28, 2026, China's real estate slump is in its fifth year, with sales, prices, and even new construction continuing to slide, but the sheer scale of unsold or vacant properties is what truly clogs the market. This isn't just a few empty buildings, we're talking about an estimated 80 million vacant homes, nearly one-fifth of all urban housing units, creating a massive structural overhang that impacts everything from future construction to potential demand for decades. Many of the largest private developers, like the once mighty Evergrande Group, which defaulted on over $300 billion in liabilities, and Country Garden Holdings Company with its similar struggles, have collapsed. But the distress is far more widespread. Even state-backed behemoths like China Vanke Company, once considered rock-solid, are facing significant challenges, with their credit ratings downgraded and bond yields soaring, highlighting that this crisis extends well beyond just the private sector and into the very fabric of state-controlled enterprises. This glut of vacant properties isn't just an eyesore, it's a fundamental roadblock to any meaningful recovery. It means drastically less demand for new projects, leading to an estimated 40% reduction in construction jobs since 2021, and a constant downward pressure on prices as local governments try to offload this immense, depreciating inventory. The lesson here is that even with unprecedented growth fueled by speculative investment, an unsustainable buildup of supply can lead to a prolonged period of stagnation, regardless of who owns the debt. So, with all these empty homes and struggling developers, how exactly is Beijing trying to navigate this crisis, and what does their policy reversal look like? Did you know Beijing just pulled a 180 on a policy that shaped its entire economy for the past 4 years? After years of aggressive deleveraging, forcing developers to shed debt, the September 2024 Politburo meeting committed to setting a bottom for the markets, a significant pivot. This isn't just rhetoric. The strict 3 red lines leverage rules, first introduced in 2020 to curb excessive borrowing, are being notably relaxed. Those rules dictated that developers couldn't exceed a 70% liability-to-asset ratio, or a 100% net debt-to-equity ratio, among other things. Now, the official line is to ease financial pressure on these struggling companies. This marks a complete departure from the previous deleveraging efforts that characterized the 2021 to 2024 period. We're also seeing monetary easing not seen in 15 years, with the central bank flooding the market with liquidity to stimulate activity. For someone looking at global markets, this creates a significantly different investment landscape compared to just a couple of years ago. Instead of a government pushing for less debt and tighter controls, we now have a central authority stepping in with support and stimulus. This is a dramatic shift, moving from a hands-off approach to one of active intervention, reminiscent of how they managed previous economic slowdowns. The lesson here is that policy pivots, especially in centrally planned economies, can happen rapidly and dramatically, completely altering market dynamics. But what does this mean for the actual price of a property, or for the billions sitting in unsold units? Did you know China's residential real estate market is projected to be worth $2.73 trillion in 2026? Now, that sounds like a massive rebound, but the real question is it? Mordor Intelligence, in their forecast for 2020 to 2031, projects this market reaching $2.73 trillion by 2026, then growing to $2.89 trillion by 2031, representing a modest 1.12% compound annual growth rate. This suggests a path to stabilization or recovery, not a return to the roaring 2010s. On the surface, Beijing's policy easing, especially the September 2024 Politburo commitment, is intended to inject life back into the sector. We're seeing developers, who were previously delaying payments on projects like Evergrande's unfinished apartments, potentially find new avenues as banks restructure facilities. But the underlying issues run deeper than just a loud headline like Evergrande's default. Caixin Global and Think China have reported signs of life in core cities as of 2026, yet the problem is that projects are still slowing down, and homebuyers remain extremely cautious. Think about it. If you were considering a major purchase like a home, and you knew about 80 million vacant properties, would you jump in without clear signals of sustained market health? The market's ability to actually reach this projected $2.73 trillion size depends entirely on 2 factors. The genuine effectiveness of Beijing's policies and, crucially, a renewed confidence from the Chinese homebuyer. It's not just about banks restructuring debt, it's about a population that has been burned waiting for a clear direction. The lesson here is that market rebound forecasts, while statistically compelling, need to be scrutinized against the practical realities on the ground. Can Beijing's policies genuinely restore confidence in a market that has seen such a prolonged decline, or are global investors looking at another subtle market deception? The answer to that question could be a massive shockwave for portfolios worldwide. But what do Beijing's U-turn and the sheer scale of those 80 million vacant homes mean for your investments in 2026? Beijing's recent policy shifts, specifically easing the three red lines leverage rules and introducing monetary easing, fundamentally alter the risk-reward equation for global investors. This market, once a no-go zone, now presents opportunities for distressed asset acquisitions or renewed investment in developers benefiting from state support. Think about it. A market that saw trillions of dollars in developer debt and plummeting sales just a few years ago in 2021 is now getting a lifeline. However, we can't forget those 80 million vacant homes. That ongoing slump signals a quick, broad recovery is unlikely. This means selective investment is key. Investors now need to differentiate between state-backed developers, like China Bank Company, which, despite past challenges, may be prioritized for state support, and purely private firms. The lesson here is that state backing is now a crucial factor. This represents a move from what was largely a market-driven crisis to a policy-driven opportunity, but with inherent risks from government intervention and potential moral hazard. For someone in your situation, understanding which developers Beijing will prop up, and which it will let fail, becomes paramount. The payoff for staying through this explanation is understanding that the old rules of investing in China's property market are out the window. It's no longer just about market fundamentals, it's about navigating Beijing's explicit directives and identifying which companies are now extensions of state policy. So, the big picture here is that Beijing's aggressive deleveraging from 2020 through most of 2024 certainly created a deep chasm in China's property market. But this recent policy reversal in late 2024, committing to setting a bottom, doesn't just erase those risks. What it does is pivot the landscape, potentially shifting it from a broad systemic risk to one demanding highly selective, informed engagement. It creates a space for strategic investment, but only for those who can truly differentiate between the underlying value and the lingering market uncertainty. The lesson here is that while the tide might be turning, the waters are still incredibly complex. Given the scale of these policy shifts, have you ever seen a government execute such a dramatic U-turn on a core economic policy? Drop your thoughts on what this means for other emerging markets in the comments below. And if you're looking for more breakdowns of how global macro events impact your portfolio, hit that subscribe button. Next, you'll want to watch my video on how Jerome Powell's latest Fed comments could influence bond yields globally in 2026.